This is the 10-Minute Contrarian Podcast. This is VP. We are a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, nononsenseforex.com, and podcast players everywhere. Episode 178 is brought to us by Bybit. I don't really think I need to explain to you at this point why trading crypto is a really, really good idea if you know what you're doing. And regardless of where you are trading, I just hope you're doing it and you're having a great time and making lots of money. If you just so happen to trade with Bybit, however, and you use my affiliate link, there are a lot of extra benefits you can get along the way as well. For example, I will remind you again, we had one of our traders sign up for a raffle on Bybit and win two whole Bitcoin. Two whole Bitcoin, by the way, which is currently valued at over $180,000 USD. And there are things like this going on all the time, but it doesn't apply to you unless you sign up through my link, which you can find down below in the Bybit blog in the show notes, because with Bybit, membership has its rewards. It is the 10-Minute Contrarian Podcast, and a quick programming note next week. The 10-Minute Contrarian Podcast will air on Sunday, not Saturday, so I'll just go ahead and get ahead of that now. So make sure you join us for that. But what we are doing today is one of the final pieces, if not the final piece, I haven't decided yet, of the dividend series we've been doing for the last few months now. And there is a reason why I saved this episode until last or second to last, because when the time comes and we have made our money through our asymmetrical investments, and it is now time to put that money away and let it work for us, this is where the majority of my money is probably going to go. Now, make no mistake, if there are still great asymmetrical opportunities out there, I will be looking at them. I will be interested in dividend stocks and dividend ETFs. I will not be losing any interest probably in gold or Bitcoin at all. But, and you saw it in the title, closed-end funds, CEFs, are tailor-made for contrarians like us. What do we do on this podcast? We look for awesome opportunities that most people are not currently looking at. Now, the one drawback with some of these opportunities is because of the asymmetrical focus we have on this podcast, is they tend to be risky, or at least have a higher degree of risk than your average investment would. And that's fine with us. We're comfortable swimming in that pool. And we know if we have 6 investments and 5 of them go to zero, if that one doesn't and that one does what it's supposed to do, then it really doesn't matter what the other 5 do. So we know the risks and we understand those risks. With closed-end funds, however, they are set up to deliver you anywhere from an 8 to 11% return, sometimes higher, with about as little risk as you're possibly going to find in the market. How can this be? I'll explain in a moment. But we learned through the rule of 72 just how important it is to shoot for a fairly high yearly percentage. Now, fairly high yearly percentage return, you could be talking 8, 9, all the way up to like maybe 12, 13% on the high end. I mean, that's amazing for a lot of people. And if you understand the rule of 72, you know why. Now, do I think we can do better than that? Yes. And I've explained why, and I've laid out why, and I've shown you how. But imagine an investment that starts with a 9% return. And if the fund does absolutely nothing all year, you will end with a 9% return, to where you're not hoping for 9% growth just to get that return. You will get 9% with 0% growth. How is this even possible? Well, I'll get into it. So closed-end funds are funds, almost kind of like a mutual fund would be, different structure, but that's not important. What's important is these things have been around for a very, very long time. And the people who run these things have lots of experience. This isn't some new thing that's promising, outsized returns. I think the oldest closed-end fund in the world is 165 years old. And the people who run these things know what they're doing. They understand risk really, really well. And they're usually older. Imagine kind of that guy with the sweater vest and the glasses, sitting behind an old desk, those guys. And they are extremely good at what they do. And when you go look through these, you're going to see some companies that are going to be quite familiar. BlackRock, for example, has a whole family of closed-end funds. There's a company out there that I never knew what they did, but if you're in the United States, you see them advertise all the time. It's a company called Voya, Voya. And they've been advertising for probably 20 years on American television. You guys, I'm sure you've heard the commercials. Voya. I never knew what these people did, but there are a number of Voya closed-end funds out there, and a lot of companies that I've just never ever heard before, but they have been around for decades, just doing nothing but cranking out really good returns right under our noses this whole time. And you don't have to go to a weird place to invest in these. They are a part of every brokerage platform in the United States. Outside of the United States, I just don't know, but I've been saying this entire time for people outside of the United States, find a way to get access to the American market. I don't care how you do it, because I would hate for you to not have access to something like this. Now, the beauty of closed-end funds as well is they don't move much as far as their price. They do move up and down, but in a much more narrow band than your average stock would. But that's good. Like I said, if these things do nothing and price doesn't move at all, we win, as long as they're able to maintain their dividend. Which, there is some risk involved here. Sometimes they won't, but that's why you have a collection of them. Because if one's dividend goes down, there's a chance another one's is going to go up. Or it's going to go up in price and mitigate any type of lowered return you would get on the one that underperforms. But in general, these things do exactly what they tell you they're going to do. They advertise their dividend return to the world. Now, how do they achieve returns like this? This is something it's really hard to wrap your head around until you learn about them. And for what it's worth, there is a book, the quintessential book on this is called The Income Factory by Stephen Bavaria. And so I'll be quoting a lot from that book. There's a few books out there on CEFs that I've read, but that's the one that everybody needs to start with. And I went back and looked through it, and I have so many highlighted passages from that book. I mean, it's a total banger. So these funds, too, are also, they don't all do the same thing, which is also kind of nice, too, because this can play to our advantage, and I'll explain why later on. But these funds can really run the gamut of business development companies or funds that deal with debt, credit, junk bonds, which we'll talk about in a moment. It sounds scary. It is not. It's actually pretty amazing. And they even kind of go off the beaten path a little bit. There's two closed-end funds in particular that strictly deal with India, which we have talked about on this program as a place that's very up and coming, very exciting, but can be quite hard to invest in too. There are closed-end funds called MLPs that deal with oil, which, as we know here, can be quite an opportunity when the overall market is falling. So, for example, and this is how it was laid out in the book, with some of these funds, with a lot of these funds, especially the ones that deal with credit and debt and things like that, which is a lot of them, probably the majority of them, the things that these funds own make it so the companies themselves that they're dependent on don't have to grow to make these returns. Rather, all they have to do is successfully pay their bills. And as long as they're doing that, then you're going to get your return. Now, if all of a sudden these companies stop doing that, well then, yeah, crashola. But the chances of that happening are very small. And this brings me over to credit and debt. You see these ratings, like AAA, triple B, B minus, whatever the case is. And then it can go all the way down, past C into junk territory. And you're like, wow, that sounds really, really risky. It's actually not risky hardly at all. The difference between AAA down to junk is not that much, really, when it comes to the probability of these places paying their debt. But the return you get is asymmetrical when you compare it to the actual risk. I'm going to absolutely butcher the quote, but it was either Buffett or Munger, and they said something to the effect of, like, the absolute worst piece of debt is still less risky than the best stock. It's just so funny. We've been programmed to think that low credit ratings and junk status is somehow extremely risky. It is riskier, but not by a whole lot. And these fund managers have seen it all before. And out of all this junk debt, they know which ones to pick up and which ones to leave, which just ups your chances even more. So really what you end up having with these closed-end funds when you purchase them is you have a group of people who know exactly what they're doing, and they've been doing this exact same thing for a very long time. And you are not receiving guaranteed returns here, but you are getting probably the closest thing to a guarantee in the actual market, with the exception of maybe T-bills and certain bonds, but the returns you're getting there are often very low. An 8 to 12% return with fairly low risk is not low at all. It's tremendous. And I haven't even gotten to the best part yet. So let's go ahead and get into the best part. The best part is, with these funds, you can take everything we've been talking about these past few months in our dividend series and simply carry it over to the closed-end fund world, thus giving yourself a much higher chance at success, because even though these things don't move as much as your average stocks or ETFs would, they still move. And so if you can simply read a chart, which all of you can, and you utilize the cheat code, also known as the monthly chart, you are probably going to get more than the dividends that you already get automatically with these things. You can take that 8 to 12% and get quite a bit more by buying and selling when your charts tell you to. Again, most people don't know how to do this. They just simply eat it when things are bad. Most closed-end fund investors just buy these things and just sit on them and let them do their thing for years, regardless if the price goes up or down. And they're doing well simply by utilizing that strategy, but that doesn't have to be us. We can do much better. And not just with charts, with fundamental analysis, which is out there, even for these things. Now you have to look a bit harder for it, and in some cases you may even have to pay, but not all cases. I would like to direct you to, this is the quintessential place for all closed-end fund investors. It's called CEFconnect.com. And it is a, just like no-nonsense-forex.com, it is a very, not the most modern website in the world, let's put it that way, but extremely functional. You can get data on every single closed-end fund in existence. You can put your own portfolio together and paper trade. And with a little bit of research, you can find other sites out there too, and places that will actually give you a bit of fundamental analysis on some of these funds, if not the majority of them. Now, I told you before, I pay for Seeking Alpha, and they really came through. So I've been paper trading a lot lately, and because it's not real money, you can take certain chances just to see how it plays out in real time. So I told you guys in a previous episode, I was investing in something that Seeking Alpha absolutely hated, and it was actually a closed-end fund. They're not all good, and you're going to want to know what the good ones and the bad ones are. And Seeking Alpha was super, super low on this particular one. I'll even give it to you. The ticker symbol is PSEC. But my charts were giving me a buy signal. So I'm like, oh, all right, let's paper trade this and see what happens. And to my absolute delight, Seeking Alpha nailed it. That sumbitch tanked this past month. You can go look at it. And it was great because that is that is the thing that I pay for doing its job, doing what I am paying for it to do. And on the other side, it also tells you which ones they think are extremely good and extremely sound and have a very small chance of crashing. And that knowledge is quite valuable as well. Now, if you don't want to pay for Seeking Alpha, there is another place I can send you. Go to a YouTube channel called The Dividend Times. This guy has something called CEF Mastery. It's this big spreadsheet with all of his ratings on it. And if you pay for it, I think it's $49 a year. And he is very prolific. He will send you an email anytime something changes on that sheet. Upgrades, downgrades, if there's a chance that this one particular fund is going to lose its dividend or have it go down. It's really for the money. Quite comprehensive. A good deal. I'm testing it out right now, and I'm pretty impressed. And I think for free, he updates a lot of stuff on that channel. It's called The Dividend Times. So there's, I'm sure, other resources out there that even I haven't found yet. It just takes a little bit of digging, and I've already given you 2 sources. 3, actually, if you include Seeking Alpha. So if you mix technical analysis with fundamental analysis, with your knowledge of sectors, because like I said before, there are different sectors within this family of funds, then what you're really doing is you're doing nothing but adding on percentage points to your overall return here. A return that already starts out in the 8 to 12% range. With your average stock, you're starting at 0, and you just hope it grows. And if it grows 10%, you get a 10% return. But with a CEF, if it already gives you a 10% return and then does nothing, you still get the same 10%. It's pretty wild. Again, these things are not completely without risk, but in my opinion, overall, far less risk than you would normally see because they are set up to be that way, just like they have been for a very, very long time. And these things have always existed our entire lives, but only a select few investors out there were even aware of them. Fine with me. I am very comfortable and very much okay with investing in things that most people have never heard of before. Because simply knowing these things exist doesn't make you crazy. It just simply makes you more aware.